Hey, welcome to another First Equity Funding Real Estate podcast. I'm with Christian Pepe and Cory Anderson, and today we're talking about rental loans, which is something that's been incredibly popular over the last few months in particular. It's a new product that we're featuring, and we wanted to talk a little bit about what the conventional options are and how what we're offering compares to some of that stuff. And I guess we'll start with Christian, who can talk a little bit about the nightmare that can be getting a loan for a conventional rental property.
Yeah, we're really excited about this product because I think for the first time it looks at rental properties in a very logical sense. I think it's something that in the conventional world that programs have kind of gotten this product wrong. Just to give a quick overview, in the conventional world and referring to more like Fannie Mae and Freddie Mac loans, when they analyze a rental property, the focus is really entirely on the borrower's personal credit, borrower's personal income, and they focus a little bit on the rental income of the property, but if that borrower's global picture of their personal income doesn't line up, the loan is going to be denied. So with the products that we're offering now, treat loans more like a commercial loan and focus more on the rental income for the subject property and concern more about the fact that does that rental income cover the debt on that individual property and less about whether or not the borrower maybe is self-employed and is a little bit more aggressive on their tax returns, or maybe opened up a new business and or has multiple businesses. Some are showing a loss, some are showing a profit, and could be disqualified for that. When you have somebody who has very strong credit, have a property that has equity in it, and you have a cash flowing asset, there really should be a more logical way to look at that, and I think we accomplished that with our new rental product.
I don't know if it drives the point home just talking about it, but if you've ever gone through it, you know exactly what you're talking about. My first year at First Equity, I was going for a conventional loan for a rental property. It was a 4-family property, so the fact that it was a multifamily, the fact that I had just started working at First Equity, the fact that I was working on commissions to an extent.
Sure.
It just, even with a co-borrower who had good W-2 income, even though we both had good credit, it was an absolute nightmare, and it was jumping through hoops. It took forever to get closed. We actually didn't think we were going to be able to get it done, and we were finally able to get it done, barely, and the rate wasn't even particularly attractive. So
yeah, no doubt. I know. For another thing is that in the conventional world, one thing that's very important to investors is having a property and keeping it in the name of an LLC. And in the conventional world, Fannie Mae and Freddie Mac in particular won't allow you to do that. So that's another big negative of the conventional world. But yeah, just a lot of frustration, a lot of unnecessary paperwork. I mean, I could tell you as somebody who has a background in conventional lending for over 15 years, the denial rate on a conventional investment property loan is through the roof. I mean, I would put it at 80% of these loans get denied for one reason or another, and a lot of it be not really having anything to do with the subject property, more about, like I said, that borrower's global kind of financial picture if everything doesn't line up.
Right. I remember actually a loan, a 30-year loan that we're closing probably next week was something I brought to you first, and being the conventional wizard that you are, even you looked at it like, because she's self-employed, she makes plenty of money, but it's just hard to qualify conventionally because there's just way too many pieces you have to fit together. It's a spider web of just information to get through, and it's just,
and sometimes
we just overlook all that, and it's the property itself and the performance, right?
Sure.
And it's like a self-fulfilling thing where a lot of the people trying to get conventional investment loans are entrepreneurial type people who don't show that consistent pattern of income because, like we said, they're self-employed or they work for commissions or they have their own business. Or they just switch jobs or whatever the case is, and so that adds another layer of difficulty, and that's probably why we get to, like, in your anecdotal evidence, 80% or something.
Yeah, that's anecdotal, but I mean, and truthfully, a lot when clients would come to me in the conventional world, and you look at these, you start going through tax returns. I mean, very quickly you just say to yourself, "Oh, this is going to be a nightmare." And for us, who we deal with a lot of people who are flipping properties. These investors are establishing new LLCs each time. I mean, that is it's a non-starter in the conventional sense. So really what I think we've done is what has been done in the commercial world for a very long period of time, and we've applied that formula to residential properties, but again, just did more of that commercial analysis or a cash flow analysis on the property is really the gist of it, and maybe we want to segue and kind of talk about the terminology, the DSCR.
Sure.
And what it is. I know it's more your background.
Well, first of all, the product that we have now, it's almost like in Cory and I talking to borrowers the past couple of years, it's almost like if you told them, let me know what you think would make sense as far as getting a rental loan. Well, they would say, why don't you use common sense underwriting? Why don't you look at a credit score? Why don't you look at how much the property makes? You could tell pretty quickly if it's a good deal or not. And that's exactly what this product is, right? So,
Yeah.
Cory, like, what are we looking for in this thing?
As you can imagine, since we're not checking we're not looking at debt to income ratios, we're not verifying income, we're not doing all these things, so we do have to have something to kind of hang our hats on, so we look at credit, so credit's an important thing.
So a score, really, right? Just
Yeah, score, and we will go down kind of to lower credit rates, but having a score of like 650, 660 plus, starting point is probably best case scenario for us to give, max leverage, and then the higher you go, that's really just going to drive the rate. So that's probably one of the most important things. And number two is the debt service ratio.
So let's talk about that. So a credit score, we typically want an average or better. It's kind of what it sounds like. And then as far as debt service, you mentioned, we're basically looking at, does the property make enough rent to support a mortgage of that amount? And so we'll look at whatever your mortgage payment's going to be. So if your principal, interest, taxes, insurance, and HOA dues if it's a condo, whatever that payment is, as we're all familiar with, we want your rental income to be 120% of that number. So if that mortgage payment every month is $1,000, we just want to see that your property is going to be making at least $1,200 a month in rent. And what happens if it doesn't? Is that still something we can do?
Yeah, so we definitely have options to go lower, but as you can imagine, the less the property cash flows, the more conservative we're going to be in terms of the amount we lend as a percentage of value. So, just to give you a rough example, and the terminology, just so everybody knows out there, is you'll hear people say DSCR, and it stands for debt service coverage ratio, and which is basically the property's ability to service its own debt. So 1.2 is preferred, and that's going to get you max leverage. So on a purchase or a rate and term refinance, we're going to get you 80% in those scenarios where Anthony said where the rent is 120% of the pity payment. And on a cash out refinance, we go to 75%, which I think is really aggressive considering we're not looking at the borrower's tax returns. And then if that debt service coverage ratio, the DSCR, if it's below 1.2 but above 1%, so 1% just means that the rent is equal to the pity payment, we're going to just do about a 5% haircut on leverage. So you get 5% less on the property, but we'll still do the loan.
And just for comparison's sake, even if you could get a conventional loan, are the leverages any different?
Yeah, that's a really good point. So some things that really, jam me up. I think across the board, probably pretty similar, just as a short answer. So on a purchase, you'll get 80% on a rental property, 75% cash out. So very similar. But believe it or not, even if you do have all those pieces of the puzzle together, Fannie Mae, Freddie Mac have very strict, they call them loan level pricing adjustments. And basically, if it's a multifamily, if it's cash out, when it's an investment property, all those things add up to hits to the interest rate. So you're going to take your conforming rate and you're going to add 150, 200 basis points onto what somebody's normally going to qualify. So when you kind of do the math, and look at our rates compared to those rates, realizing they're pretty comparable, and there's the ease of getting the ease of process, and again, keeping a property in the name of the LLC, from a liability standpoint, but also from a tax benefit standpoint, I think there's a lot of advantages.
And as of July 18th, 2019, the 30-year rental rates are in the 5.5% starting, or 5% on the ARM.
I would say the ARM pricing is in the mid to high fives, and then the 30-year fixed rates start in the low sixes. You might get a high 5 handle on a 30-year fixed rental loan if you're at a good credit and a lower LTV. But to get that max leverage, the 75-80%, you're going to be in the low sixes. Where in the conventional world, conventional rates have actually come in a little bit recently, but we're still talking. I would say mid to high fives on a conventional loan.
And just from my experience, that was my rate was in the mid fives.
Mm-hmm.
And if I knew all the hoops I had to jump through, I would have took something at 6 or low sixes just for the ease of getting it done. And I would have had no problems. So at the end of the day, we're looking at the same leverage. Rates are a touch higher, and the most important thing being you can actually qualify for
get
it.
it done.
And then the liability aspect of keeping it in an LLC, which is a big no-no for the conventional loans.
Right. So as far as that, No, it's a great tool. I don't know if I want to segue into that yet, but I mean, it's a great tool for some already existing investors. You know, some of the fix and flip guys that maybe don't want to,
Yeah.
start
Some for
forward, right?
instances, and you guys are seeing this, more on the street probably than I am in your role. But we're seeing investors that are buying, fixing, and holding. And the interesting thing with this product is the leverage that we'll give. So after a 6-month period of owning a property, we will go off current value and cash you out up to 75% on that new value. So in a lot of instances, investors are able to buy something and fix up, maybe using a hard money type loan, and then we're able to allow them to recoup all their fund, maybe most, or in some instances recoup all of their money and still have a cash flowing asset, which is just a tremendous thing.
And that's not just lip service. We're doing those deals right now. I mean, the borrowers innately know that this is an awesome opportunity. The biggest problem for us is that a lot of borrowers don't know that this product exists.
Yeah.
So the more we spread the word about it, borrowers are really excited. And I just finished a deal in New Jersey where we lent her the money to acquire the property. We lent her all the money to fix it up. She finished the project in about 6.5 months, or actually 5.5 months. By the time her rental loan was ready to go, she was at the 6-month mark or so, and she got 75% of the new appraised value. So she recouped all of her costs, plus she recouped some extra money.
Yeah.
Now she owns that property. It cash flows really nicely. She's got a good long-term loan with a low rate, and now she already bought the next deal.
Yeah, and she's got no basis in the property.
No
right?
basis.
I mean, it's an incredible thing. And listen, not every property is going to work out exactly that way, but if you're still able to recoup most of your funds and move on to the next one and have, this is the long-term play that we're starting to see our investors, a lot of people are doing. Everybody needs to do the fix and flips to make their, that's how a lot of our investors make their money, but everybody's, now starting to focus on that long-term game, and I think this product's going to really allow people to do that, where honestly, even a year or so ago, had much more limited options or inability to get these done.
And I mean, another thing, I mean, don't you get capped out at 10 loans, for your personal?
Yeah,
Right.
that's a good point
with
too.
This loan, I mean, it's
And some lenders even less. So selling directly to Fannie and Freddie, I believe it's 10, max 10 loans, but some individual banks will just have their own overlay where they'll say if it's more than 5, we don't want to have anything to do with that. We just think it's too much exposure. Where we'll definitely expand that. Another thing is we do these loans for foreign nationals, and that's something that
Right.
a lot of maybe you'll get a community bank that might consider that, or a credit union, but in the Fannie Freddie world, those things are harder to get done. So.
In our experience, I think what's been really popular is using this type of financing on multifamily properties. Now, we talked a little bit earlier about the debt coverage and how we want that to be at a 1.2 or better. I've yet to see a deal come across my desk where everything else is fine, that the debt coverage didn't work on a multifamily. It almost always does. So if you're keeping properties for cash flow, typically the more units you could have under one roof, the better. So on your 2, 3, and 4 unit properties, which this loan is for, it is 1 of 4 family, this loan works particularly well. So
Yeah, and then we still offer the flexibility. So and I mentioned this just for the people listening in New Jersey. New Jersey obviously has higher home values and higher property taxes. So we do see some properties, especially in the single family area, where the debt service is a little bit harder to get to. So that's where we do have that ability to go lower. You might need to put a little bit more money down, but you could still buy. I'll give the example of the something at the Jersey Shore where our office is located. I mean, values are really high, and it's hard to get that long-term rental. And maybe you are layering in some Airbnb. Kind of rental options as well, and maybe probably not today, but I think on a second call, or we're going to line up and be on the lookout for some webinars and some training where we're going to give some more in-depth information on what rent is used, how you qualify for these things, and then for the for the brokers or mortgage bankers out there that don't have outlets for these loans. We are rolling out a broker and correspondent program that's going to allow brokers to be able to help and service their clients and offer these loans through First Equity.
it's a good point with the higher value properties, and we're looking at a deal right now where that's the case, where it's a really good property, it's really well located. It's just that the rental income from the house is just a little bit too low to hit that 1.2. So it's really nice to know that we can still get the loan done for the borrower,
Sure.
even down to neutral cash flow.
Yeah, and it makes sense for that client, right? Because I mean, you may say to yourself, well, why does anybody want to have a property that the cash flow is even or maybe even negative in some instances, which we will consider as well. But it's the appreciation play. When you have properties in, I'll just name a couple towns locally, like in a Belmore or something where or Seagirt or Spring Lake, where there's really higher value properties, but with the summer rentals and the Airbnb, you could really get a lot of cash flow. But there's some seasonality, but you're also seeing these properties appreciate way more than other areas.
And that's exactly the play here. Is he's buying in the path of progress, as they call it, and so he wants to hang on to this property for the next 5 to 10 years.
Right.
And if the mortgage is covered by just enough for the rent, to be neutral, that's fine for him. And so we were able to help him out with financing in that case.
Yeah, that's great.
And you're even you talked a couple times, alluded to like Airbnbs,
Yeah.
which is something we can fund also now, right?
We can, yeah. So, I mean, we do want to see that in order to use it as qualifying income, we do want to see that there is a history of getting that Airbnb. So if, somebody has a registry of what they've received, over a 12-month period for Airbnb, yeah, we'll consider that as qualifying income.
Which, by the way, is an easy record to get if
Yeah.
you're renting through Airbnb. Those are easy records for you to come up with, and
Yeah.
particularly in tourist areas like the Jersey Shore, that's particularly a popular way to use your property. So we're able to offer financing in that case.
Yeah, and then just one other thing to mention. I mean, we do offer these as 30-year fixed products, but for investors that are looking to save a little bit on the interest rate on a property where they know that this is not a super long-term play, maybe it's a 3 to 5 year play, we do have some ARM options as well. Right now we have a 5-year ARM, but we're in the next month or so we're going to have a 3-year and a 7-year ARM, which is really nice for that way they could save on the coupon and know that they may be just not keeping on to it forever.
And then just to be clear, the 3, 5, or 7 means that's the initial term where you do get a fixed rate, and then the rate will adjust every year thereafter.
Yeah,
but
so
it's still
they don't
it's still a 30-year
Yep.
loan.
Yeah, still 30-year loan, where though the interest rate instead of getting 6.25, might be 5.5 or something like that on a shorter term loan or fixed period.
Right. So yeah, I mean that's about it. Did we miss anything else on this product?
I don't think so. Yeah, I mean, I guess I would just say to anybody out there that's considering this, or maybe if you haven't had a rental property, or you're legging into this, or you're considering maybe cashing out on an investment property, and quite honestly, if you've just been denied or gone through a ton of hoops and just gotten frustrated, by the banks, it's worth giving us a call, even if you're not totally ready or don't have something in mind, just to understand the concept, and it's because then you can kind of crunch your numbers and really
Sure.
start to say, man, wow, I could acquire this property, I could buy it for this, put this much into it, recoup my money, and start to do your own kind of analysis, and I think it's an exciting thing.
Yeah, and you're a loan officer here at First Equity, whether it's myself or Cory, we're happy to run through the deals with you. I mean, we're both investors. Christian, you've flipped over 100 homes. You own some rental properties, as do we, and we're happy to put numbers on paper with you and kind of go through what we think is going to be a good deal for you or not, and kind of give you some scenarios. So
Yeah, absolutely.
if you want to reach out to us, fefunding.com is the website, 732-359-7800 is the main number. Ask for Cory or Anthony, and we'll be happy to get you guys going, or give you any information on the rental product or anything else for that matter.
Yeah, that's great.
All right.
All right.
Thanks for
Thank you,
stopping by.
everyone. All right, bye-bye.